Well, it's been a big day for U.S. economic data with the latest job openings and manufacturing activity out. And here to break it all down is Mike McKee. He is Bloomberg International Economics and Policy Correspondent joining us on set. And Mike, let's start with the JOLTS data, because looking at this, it seems like it's pretty good news for the Fed.
It is reasonably good news for the Fed, although the 9,582,000 job openings that still exist tell the Fed it's still a fairly tight labor market. It is progress in the right direction, falls from the prior month at 9,824,000. So not a huge drop, but enough that it tells the Fed they're going in the right direction. Quit rate fell to 2.4% from 2.6%, so the Fed's going to be happy about that. It shows people a little less confident that they can get a new job if they leave their current one.
Yeah, it's interesting. I mean, because you look at that chart and you think, okay, that's a sign of a relatively strong labor market, at least from the perspective of the workers. Again, not necessarily for the fight against inflation, but sort of overlay that with some of the other data that we're getting, particularly when it comes to manufacturing, which we know not quite as big of a component of our economy as it used to be, but it has to be concerning. What are we, like 9 straight months of contraction now?
Yes, for the manufacturing ISM, 46.4. It's a tiny little bit higher than it was last month, but the employment number falls down to 44.4 from 48.1. So it suggests that maybe companies are either not hiring anymore or they are starting to let people go. We'll find out Friday when we get the jobs report whether we're having an employment impact from manufacturing. But it does suggest manufacturing still has a ways to go to recover. New orders rose a little bit, but only to 47. So they're still below that break-even 50 mark.
Let's talk about Friday. Another jobs report. Feels like it comes every month. We're expected to see the unemployment rate hold steady at 3.6%. But when you look at some of the details of the report, what will you be keeping an eye on?
Well, unemployment is going to be a very important number because the Fed is expecting it to rise over 4%, Fed officials are. And if that doesn't start happening soon, it's not going to make it by the end of the year when they think that's going to happen. And the unemployment rate rising would be a sign to them that they are starting to push down on demand, and that would help balance supply and demand and bring down inflation a little bit more. We'll be looking at the job creation numbers, although they keep coming in higher each month than the estimates. The estimate is for 200,000. That's a slowdown, but that's still a very strong number in the long line of things. So that, and then obviously average hourly earnings, the Fed wants to see those come down a little bit. They're over 4%. They want them more in the 3 to 3.5%.